Welcome, everyone, to the fifth and final day of the 2022 Definiti Retirement Academy. We're delighted to be hosting you this afternoon in the advisor track of our academy. For those advisors that are in attendance, you're probably already familiar with the fact that there are two tracks to the Definiti Retirement Academy, our plan sponsor track, as well as our advisor track. Here on day 5 of the academy, we have some great content for you. We're joined by our partners at Securian Retirement to give us some insights on the cash balance opportunity, how it works, and how to capitalize on that opportunity with our clients and prospective clients. And then we also have our partners from the Standard who will be joining us later this afternoon to discuss state mandated plans, their impact on the retirement industry and the opportunity that it presents for us all. I want to make sure that here on the last day that I pay particular attention to thanking all of our sponsors and partners who have been part of this event this week. You can see the folks and the names there on the screen. These are the relationships and organizations with whom Definiti maintains intentional relationships with from a business development as well as thought leadership perspective. Without their support and their friendship, the Definiti Retirement Academy and all of the other programming that we put together for our advisors throughout the course of the year simply wouldn't happen. So what I'd like to do right now is just remind you of what you're a part of here in working with Definiti and taking part in our Retirement Academy this year. You've joined this year no less than 700 distinct advisors and plan sponsors who have chosen to join us, who may or may not already be doing business with Definiti, but certainly saw value in the thought leadership and information that we're providing in both our plan sponsor as well as our advisor tracks. One thing that I would encourage you to keep in mind going forward is that we hope for and expect your feedback on your experience this week in joining, whether that be all of our sessions or several of our sessions. Let us know that what's important to you, how we can do better and be better every day, whether that's through the Retirement Academy or through the products and services that we offer for you and your clients. So all that being said, I'd like to get the day started. As I mentioned, Securian Retirement has joined us first. We're joined by Matt King, who's the National TPA Vice President, Norm Gaskins from Securian Asset Management, as well as Dave Foley, who's the Regional Vice President for Retirement Sales based out of the greater Chicagoland area. So Matt, Norm, Dave, thanks so much for joining us. And Matt, I'll kick it over to you to get us started.
Perfect. Thank you, Thomas. Appreciate that intro. Thank you, everybody, for joining us today on a Friday, midday. Could be morning, could be afternoon where you are, depends. But thank you for taking the time. We really do appreciate it. Thomas stole a little bit of my opening comments because I wanted to do a quick intro for Dave and Norm, but we can save time to talk about cash balance and move past that right away. But I am thrilled to have both of these gentlemen with me. Dave I worked with for many years, and Norm and I have been together for just over my time here at Securian. You're not going to find two more genuine and nicer folks and knowledgeable folks about not only the retirement plan business, but cash balance as well. So thank you for both of them for joining today. Few housekeeping items. You're going to notice a little bit of a different approach to our session. We do have slides. We're not afraid to use them, but we prefer not to. We felt that coming into this, a dialogue in perspectives, kind of the interviewer style approach to this topic would be better. We may reference some slides when it gets into what Norm's talking about, but we're going to hang tight. We'll just get to look at our beautiful faces for most of the time, hopefully. So the other item is please ask questions using the chat feature, right? It's important that we're going to get off on some tangents. We want to make sure you get some value out of this. Ask the questions. If we have time to answer them, we absolutely will. If we need to derail a little bit on a hot topic, we absolutely can do that as well. Before we go into the content, a couple items in terms of opening comments. First of all, thank you for Thomas, Brennan, and the whole entire Definiti team. They've been great partners with Securian for the last handful of years. We really appreciate it. We love the idea of this type of event. It certainly shows their leadership doing something memorable and different like this in the retirement plan space. So thank you for having us and thank you for giving this opportunity. Next topic as many of you are aware, and a little bit of a giggle there on my part, the Standard, the folks who are speaking to y'all next, is acquiring the retirement division of Securian. I wanted to just give a few brief minutes of feedback on that. I sit in a unique position, and I think a really good position. From 2015 to mid-year 2019, I worked over at the Standard and left to come to Securian. And it was a great opportunity, but it was a difficult decision. And here's why. There are a lot of similarities, right? The culture is very much the same. The processes, the focus on retirement planning, very much the same. But the biggest challenge, the biggest obstacle for leaving, or the challenge for me to say I'm going to go over here now, was the people. I think that what you'll see coming out of this joining of two families is going to be one great company with great people working there. Those who believe in transparency, doing the right things, being very, very professional, customer focused, right? All those great things that you know individually from Securian and the Standard, you're going to see on a greater scale after we migrate the two companies together. So just to give you a little bit of that insight, we're excited about it. We're moving forward as things are moving rapidly on our end, but we're excited about it. If you've got any questions, obviously, about the coming together of these two companies, reach out to either your Securian person, and I'll probably steal some of Rita's comments, but you can certainly reach out to your Standard person as well. So with that being said, I think it's time to jump in. Dave and Norm, you guys ready?
I'm ready whenever you are.
All right, cool. So Dave, just to lay some groundwork, you are our regional vice president, so our sales guy, right, in the Chicagoland area. Talk to me a little bit about what you're seeing in the marketplace out there, retirement plans post-pandemic. Let's call it post-pandemic. It's still hanging around out there, but things have certainly gotten a little bit more active out in the marketplace. Where'd everybody go?
That's a really good question. And again, thanks to Thomas Brennan and team at Definiti for giving us this opportunity. It's great to see old friends and colleagues. That's a good thing. So I like you said, I'm in Chicago, and obviously different areas were affected differently. Based on the pandemic, based on really, I guess, how their region actually kind of reacted to it. Chicago was really affected because they really did close down. So it was really hard to get in-person meetings. But I would say that the reaction in the business market post-pandemic was really what you said, Matt, which is, where did everyone go?
Right.
So post-pandemic, many employers and probably the folks at Definiti, like the great rep we have here in Chicago, John Kelly, could tell you, is that many employers were, saying, where did everybody go? And they were really kind of struggling, not only to retain clients, retain workers, but also to recruit new employees, right? So a lot of people kind of disappeared during that. So the question when we go in to talk to employers is like, where did my employees go? Where did everybody go? So besides like job changers, which was pretty common, so people that maybe jump ship, maybe for work-life balance, or maybe because they could get paid a little bit more. What I saw was actually kind of unique, and my guess is that it's probably pervasive based on what I've seen in terms of sales at Securian, and my guess is the folks at the Standard, soon to be our new colleagues' experience as well, is that there's kind of a renewed kind of entrepreneurial spirit, because we saw a huge increase in startup activity, right? I know that's not the most attractive business to advisors, but $1 billion plan has to start somewhere, right? So it's going to start in the startup space. So we saw a huge increase in startup activity. Also, I think the Standards topic is extremely timely. Because, I don't know how many states it is today, and I'm sure they'll know the number, but I think it's close to in the 20s of states that actually have mandates where, based on if an employer has a certain threshold, like, for example, in Illinois, it's it's going to go down to 5 if you have 5 employees and been in business for more than 2 years, regardless of their status of being, part-time or full-time, that you have to have some sort of retirement plan or you have to join the state plan. So I'd say that's 2 things, right? Is that you've seen an increase in startup activity for 2 reasons. One is I think is because of that entrepreneurial spirit, right? So people that have left employment and decided to set up their own company, and also, businesses that, predominantly are just for maybe demographic reasons or cost, have not necessarily had a plan that are being forced to make a decision because of the state mandates. Ironically, I think it creates a huge opportunity for cash balance plans. Because in my experience, not that they don't happen, right? Which is like adding a cash balance plan to an existing plan. It absolutely does happen. It tends to be kind of a slower slog, right? It's trying to get everybody to kind of make a decision. In my experience, it's been easier to sell cash balance in the startup space. Get it from the go, like just show the benefits in combination with the defined contribution plan.
Just doing it all
Do it all at once,
right? Do it all at once. Right.
Yeah, exactly.
So is this something, I mean, because you've been selling for, I won't say how many years because we go back a few companies, but it didn't seem like cash balances were like the hot topic, right? Now all of a sudden they are. Is that true? Is that kind of like?
Yeah, absolutely. Absolutely. Yeah, I think they're coming back with a head of steam, right? Because I think there's not a focus on cash balance when you've had tax cuts, which do help a little bit.
Sure.
You do have I can't think of was it the 199 benefit, that the QBI benefit that came in. So I think that saw a little bit of growth in the cash balance space. And if you want to talk about that, I'm sure the folks at Definiti have information and can provide illustrations to show the benefit of, reducing your taxable income based on how your corporate structure works.
Right.
But also, when the market's going up, right, a lot of people, the wealth effect actually kind of hinders a little bit of the growth of the cash balance side. That's why I think you really kind of have to be really intentional in terms of the companies that you target. So like, as far as like positioning, I kind of hold true to like presenting cash balance plans to, closely held businesses that are profitable, right? So that tends to be, companies that you should really focus on. Look at companies that have a lot of family members on the payroll. Because it's an easy way to kind of maybe transition the business through, the cash flow that's available. Based on economic situation today, I think you probably want to focus on businesses that are really kind of recession proof. So, companies that have a unique niche or a unique market that can't be affected by, the business climate. Also maybe focus on, things that people always need, right? People are always going to go to the dentist. They're always going to go to the doctor.
Doctors, lawyers.
Yeah, exactly. Like the professional organizations.
Right? Okay.
Yeah, those tend to be the easier ones to kind of set up and to present. There's fewer decision makers, maybe more partners, more family members. So it tends to be a little bit easier. And focus on companies that, that somebody that really wants to increase their contribution amounts, kind of skirt the 415 limits and really be able to put away a lot of money. So they're actually looking for tax deductions. Yeah. So I'd say that it's really crucial in those circumstances, like early in the process, to get the CPA involved, right? So if it's, if you're working with your Definiti rep, and you're presenting an illustration, ask the advisor, ask the employer to get their accountant involved, because if you can show the value of the deduction and the benefit to the accountant, they tend to be more of a trusted partner than the advisor, more likely that you're end up getting, get the plan implemented.
Gotcha. Okay. So huge benefit to closely held companies, like with family members, that's a good fit. Or doctors, things that we're always going to need as human beings, right? Those types of groups are always a good fit. Do you always sell them in when you're out there selling? Because I've seen a few come in this year, combo versus standalone. Is there any either way, or is that just on a case?
Yeah, I think either way. I mean, my guess is that I don't see it as many of the solo cash balances as maybe like a third party administrator would see. But what I hear from our partners, like the TPAs that we partner with, and specifically we work with firms like Definiti that provide that, the fiduciary services and the great consultative approach, is I hear from our partners that there's a ton of growth in the solo
In this
cash balance
space.
space.
Yeah.
Yeah, just because,
We've
a
just
lot
seen
of
a
people
bunch more come in, right? A lot more
Yeah.
come in this year. Yeah.
Absolutely. Especially if you're somebody that probably worked in kind of a consulting capacity at a larger organization, and then you break out on your own, you have tons of relationships, you're making consistent income. And maybe you might be a little bit older and you're jettisoned from the corporate structure, and you have like a short time frame where you need to kind of accelerate your contributions in a short time frame. There's nothing better than a solo cash balance. I mean, a lot of times people lead with the DC plan, but in those circumstances, nothing can replicate the tax deductions and the contribution levels that you get.
It's a great solution. I mean, it's definitely a great solution, right? Definitely a great solution. So when you're working with, I mean, I know if I were to ask you, who are your customers, certainly pretty much everyone, right? Between TPAs, advisors, plan sponsors, internal partners. But let's focus on advisors and financial professionals, since that's who we're talking with today. What are the struggles and the worries that when you're having conversations like, hey Dave, this is Jimmy O'Brien, blah blah blah, I got this deal. Good Irish, right? Jimmy O'Brien, the advisor.
That sounds like Chicago. Yeah.
Chicago, yeah, right.
Yeah.
But I'm worried about this. Like, what are you hearing out there in terms of what the advisor's struggles are with cash balance plans?
Yeah, I'd say there's two things. One is that, I definitely would encourage advisors, and when advisors come to me, looking for, a referral to a TPA, I do really focus on firms like Definiti that provide, kind of an unparalleled value proposition, which is not only are they giving you the great kind of fiduciary mitigation resources, more importantly, they have actuaries on staff. It makes me a little nervous when that kind of stuff is kind of outsourced, just because, a lot of times advisors and plan sponsors, want to be able to call somebody and talk to somebody pretty quickly, right, to get answers. So I kind of push them towards, kind of the larger organizations that have, feet on the ground, like we have in Chicago, like John Kelly, who are there to meet in person with plan sponsors to talk about it. Because it is a big decision, because there is commitment involved in the cash balance plan. Right. What makes me nervous, like nowadays, I think what makes advisors nervous is actually the market, right? The market can be scary. I kind of remember, and Norm, being an investment guy, could probably talk about it a little bit better. But the market kind of cratered at the end of 2017. We had a great year, and the market went down at the end of 2017, and it was a surprise, right? So for a lot of cash balance plans, especially because they're managed in kind of like a pooled account, right? And they use the 1231 valuation to kind of determine what's going to happen from an actuarial perspective. That is the biggest risk, right? Is either a down market, a bear market, an awful market like we've had this last year, or you have something terrible that happens in December, like right when you're getting close to when you kind of post, what the amounts are that are going to be used for actuarial purposes. So, from my perspective, I think besides trusting the resources as an advisor, like working with a quality third-party administrator with actuarials on staff, the bigger risk is like who's going to manage the assets. Because there's a lot of risk in managing the assets. Who's really responsible for it, I think, has always been kind of ambiguous in the cash balance space, because, like I said, it is a pooled account. It tends to be trustee directed, right? But ultimately, the buck stops with the advisor, right? So if who's going to be responsible for if the assets underperform, that could cause increased contributions, and there's things you can do to like amortize the losses and stuff like that. But who's really responsible for it? The employer is going to point, or the partners at a firm are going to point the finger at the advisor. So you want to make sure that you don't manage the assets not like you would do like with a private wealth client, or like you would do in a DC plan. You really got to manage for risk and not for returns. The goal ultimately is to get as consistent returns as close to the actuarial assumption that's in the plan document. So what it seems like advisors looking for is like help, in that space, is kind of looking for, obviously they could use brokerage, right? Which tends to be the most common option. But, it depends on what kind of resources they have at their firm to, kind of manage those assets. Because I think you don't want to kind of just set it and forget it. I think you want to be in an investment option that really is, allocated with maybe some unique asset classes in order to manage risk, but then probably more importantly is probably tactically managed to kind of take advantage of the changes in the market. So I think that those are the things that I kind of see. Gotcha.
And how do you position? I mean, you've mentioned partnership with TPA, certainly with Definiti, positioning them. I mean, that's, for me, and I'm certainly biased. I've been working with TPAs most of my career. Certainly, that to me is always the best solution. Do you find that that's true when you're talking with advisors? That's, let's be honest, right? I mean, there are certainly bundled options. We have them at Securian, but partnering with someone, and you talk about Definiti's value proposition, I just, again, from my 2 senses, having that expertise on that, on doing the cash balance work and things like that is just invaluable. Do you agree?
Yeah, no, I agree. I mean, even though, we're an insurance company, right? So the whole organization, I think besides the sales team, we're the only department that's not managed by an actuary, right? So, the whole company was managed by actuaries. My home office is not going to present to you, right? That ain't happening, right? So our actuaries and, our DB consultants and cash balance consultants are not going to sit down across, Dr. Smith and, present the value of it, right? And because it's such a big decision because of the commitment, I think a lot of things have to be done face to face, or now in the new world of Zoom, where somebody could look somebody across the eyes and say, I trust you, right? And I think that that's not only their sales expertise, and I would also say the TPA, like Definiti reps, their ability to help you identify clients and identify prospects. I think that is a huge value, so you don't waste your time, right? So they can tell you, one, it's a good fit or it's not a good fit, or if you don't have opportunities readily available in your current book of business, they can help you use the data that's readily available to kind of identify prospects.
Exactly.
I mean, not only can they help you not waste your time, I think that bringing your Definiti rep with you can absolutely exponentially increase your closing ratios.
Yeah.
They're going to do so much better than me sending you my home office illustration of what's the tax benefit and what the contribution limits. Because there's a lot of consulting, because sometimes you get the illustration and Thomas's team could talk better about it. Well, they'll say, well, I can't do that. When's if I want to do that? Give you alternatives. And I think that's the huge value, the TPAs provide, is because they could talk about the what ifs and what can, right? Like what you can do.
Cool. All right, Dave, I'm going to give you a break, let you grab a sip of water, because I've been kind of picking you on you for a bit, but we're going to turn over. We'll get a flip a little bit and talk with Norm about a solution that we offer at Securian. And again, with my comments earlier about what's going to be going on here in the next few months, as far as we know, this solution that Norm's going to talk about with us will be available come next year and for the longer term. And our hope certainly is that that's going to, when we get over there, it'll be offered with standard folks and then the combined companies as we go forward. So Norm, what do you think about what Dave said? He said the word risk a lot. He talked about funds. He talked about who's going to manage, who's going to do this. What's Target 5 about?
Sure. Thanks again, Thomas, for having me on. Matt, thank you. I want to start out with picking up on that creator conversation 2017 with Dave just brought up. I was actually working in the retirement world with Securian Retirement, got a call, and I had an advisor on the line, didn't de-risk in time. had a big tax problem with the big plan. Asked for a solution. The plan wasn't with our plan provider, but he wanted to move it to us if we could find a solution that would be able to monitor and manage the assets. And I'll tell you, I worked pretty hard trying to find a solution. I won't mention any of the competitors, but I looked around to find out if anyone managed the portfolio specific to a particular crediting rate, a future crediting rate for that matter, which is the percentage of the rate there. Couldn't find anybody. A lot of risk-based portfolios, and moderately conservative, some moderate portfolios, and then of course, the advisor themselves. The reason why this particular advisor wanted this solution is because cash balance plans are unique to a risk-based portfolio, or for that matter, your wealth management clients altogether. So you are managing risk based on timeframes and risk tolerances with your clients. In a cash balance plan, you're managing to a specific percentage. And if you don't hit that percentage, there's consequences to both the plan sponsor's tax situation, or in this case, a makeup. So there are consequences if you don't hit the target. So we did some research and work. I then in 2018 moved over to the asset management side of our company and learned that we were doing an enormous amount of business in the pension risk transfer space. And in a nutshell, what that is a bunch of mid-sized companies transferring risk and liability off their books to an asset firm, typically an insurance company like us, where we would manage those liabilities and make sure that we hit that return. And so we had a whole group that did that, but it did it on an institutional basis. We have billions. We do billions of dollars a year in that, and we have billions on the books. So we try to figure out how can we bring something like this to the retail space, and giving it a feel that would allow us to manage this particular crediting rate for an advisor in an institutional type of environment. And what we came up with was cash balance target 5. And the reason we use target 5 is because that's about 80% of the cash balance plans out there. So it was a big window of breadth to do that. And our objective was really to hit a 5% net rate of return with a 7% gross rate of return. And the reason we did that is we wanted to build some cost or some return in there to pay for some of the plan costs, whether it be the administrative costs, whether it be the record keeping costs, or your cost, the advisor cost. So we're shooting every year for a gross 7% with a net of 5%. And we've had a really good couple of years doing that with this particular approach. We've got and when it comes to the allocation, let me, I want to step back. I want to take the elephant out of the room.
Okay, go ahead.
Return.
I know you seems like it. Yeah, say it. Talk about it.
Return in 2022.
Yeah.
Right. That's the big elephant in the room. In our case, our portfolio right now is at negative 11.8%. In average portfolio, that's a 30-70, which would be considered a conservative portfolio. Some of our competitors are using that. It's right now at negative 17. A moderate 60-40 is negative 18. So this particular portfolio is
I'm not hearing any positives.
Yep. Well, and the reason you're not hearing the positives is there's only one asset class literally that has performed in the positives year to date. And that's energy.
Right.
And pretty substantially. But that would be a big bet and probably not fiduciary prudent if we're trying to drive only 5%.
Exactly.
So we need to be diversified in that respect. We have portfolio managers that manage the pension risk transfer that also manage this particular investment. This is a commingled account. So meaning everybody is mingled into this particular account, and we manage this portfolio for three ways. We do it based on contributions coming in.
Okay.
Distributions going out because cash balance plans do pay out. We need to make sure we bill for that. And then the overall rate of return that we're trying to get for that crediting rate, which is 5% net.
Right.
And so it's a different type of investing. We do not invest like a risk-based portfolio. We based it on liability driven investing, which is unique to the industry. I still have yet to find someone that's investing kind of like we do. And why is this important to an advisor? First of all, we're doing everything we can, just like the big institutional plans, to get to that crediting rate. But more importantly, it frees up time for the advisor. So the advisor, in a normal circumstance, you typically rebalance quarterly. If you're really prudent for your clients, maybe annually or some big event. With a cash balance plan, you have to watch this on a fairly frequent basis. And then you have to decide at some point throughout the year, when are you going to de-risk? You have to capture that 5%. The risk is actually exceeding that. And then next year, when they go to make a contribution, the plan sponsor may not be able to put as much money into that plan. So you have to have a time frame to de-risk and make a decision. In our situation, this portfolio has been set up for 3 years now. Like I said, we just got the novel idea in 2017, or really into 2018. And the first year we hit our 7%, and we de-risked around Christmas time.
Okay.
And last year we actually hit close to our 6.8% when we de-risked. We did that around Thanksgiving time. So we'll de-risk in that fourth quarter, depending on what the markets are doing. We have not de-risked yet. We got 5% yesterday. It was great. But
Celebration.
For once. But who knows what today's going to bring us, right? So we're still fighting to get to that 5% in our portfolio managers. This may be all the way to the end.
But it's not a guarantee, right? I mean, that was something that you and I had talked about, where I was like, and in this industry, we all know that word guarantee is not something we should be using that often, if at all. Right.
You're absolutely correct. So it's a targeted rate. We're doing everything we can each year to actually achieve that specific rate of return. We don't want any alpha in there any more or any less. We want that rate of return because it's built purely for a cash balance plan.
Right.
But it is not guaranteed. There is no annuity or some type of guaranteed contract behind it.
Gotcha.
Yeah.
Okay. So I'm trying to think what the next question is. So in terms of what would be your sales pitch, right? If I was an advisor and I'm like, listen, I really want to go and do this another way. What makes, and you've said a lot of good things about Target 5 and just the fact that we're the lowest negative for the right at this point. I think that's good.
Best of the worst. Yeah.
The best of the worst these days.
Yeah.
Not bad. We'll take that. Yeah. But what's your, because I know you do a lot of travel and you do meet with advisors throughout the country. What do you really focus on when you talk to them over a conversation about that to sway them to go with the Target 5?
Right. And I've been in a few large RIA shops that's all they do is cash balance management. They do it internally. They have investment advisors inside and they're pretty prudent with it and it looks good. Our allocation, we have about 15% in the S&P 500. It's a defensive S&P 500. We have cash about 24% because we have to pay out those liabilities.
Right.
We have high yield. We have intermediate, and then we use covered calls and puts or just options in general to make the equity portion defensive. And that's exactly what we're seeing with some of these large IRA firms. A lot of times in a mid-sized company or these cash balance, if you don't have the resources to be able to get into the options market, to be able to invest like this to try to reduce some of that volatility in the market, this would be a great opportunity for you to get some exposure for your clients to that.
Right.
It also saves a lot of time. I don't want to call it a forget and set it and forget it, but you want to make sure that you're out there doing what you do well, and it will free up time if you use our solution. It has been proven, year over year. But I think one of the biggest benefits is if you get a situation right now like we do now with the systemic market, right? Systemic, this is market risk, and nobody is getting return anywhere. But yet the plan sponsor looks at you, the advisor, whether you're using my solution or you're doing it yourself, and says, you're the best of the worst, but you didn't give me my 5%. Right. And you may have a $40 million plan that's on the DC side in assets, and then you have a big DB or this cash balance plan. You're the quarterback as the advisor. You can fire me or my solution and manage it still and probably recover your plan. If you're managing it yourself and they're upset, you're out of options other than I'll do better next year.
Right.
And so that's we're seeing a lot of that, especially with this year's market. We're seeing more assets this year than we have in any other year.
Right. We're still at the mercy of the markets.
Absolutely.
Yeah. Can I make a comment too as well? Right.
You absolutely can. Yeah.
Yeah. So the key thing too is it doesn't have to be all the assets, right, into like target 5, right? So, you could use the target 5 that's managed tactically using risk and options. You also could have something else in there, like a stable value, if you want to, solidify a portion or if it's larger, if the actuarial suggests that you have a portion in cash in order to do payouts yourself, right, at the plan level, if you got people receiving benefits, you can mitigate some of the volatility by using other strategies and using, the target 5 as kind of a complement for a pool to the asset. So, we've seen advisors using a stable value or an insurance company general account for part of the allocation, because then they're kind of get some risk backstop. But then also having, the target 5 is kind of a sleeve. But believe me, I'm not an investment guy, right? So that's something, as an advisor, you have to evaluate your choices and things like that. We're just, offering, kind of an investment solution.
Right. And Dave, you've sold target 5. I mean, outside of this market conditions where we're seeing, but and I hate to make it about feedback, but listen, it's all customer based, right? It's outside of this market, folks. I mean, people are happy, right? We're hitting that 5%. Yeah. Everything's.
Yeah, I mean that's I mean, for the advisors that are using it, the questions that Norm answered, which I think most advisors have top of mind is, advisor would ask me is like, when did they tactically go to cash, right? Right. The analogy that I always use, and pardon me, right? So Thomas and Matt know that and probably John Kelly here know that I'm kind of a joker, but my favorite game show is The Price is Right. I don't think they've ever created a better game show than The Price is Right. And on The Price is Right, they used to have a game where it would have a Swiss guy climbing up.
Oh yeah.
Yeah,
exactly.
They
play that crazy Swiss music. Yeah.
Yeah, exactly. And then he was like yodeling, and then the yodeling.
Yeah, the yodel guy. Yeah.
Yeah, that is probably the easiest way to kind of explain, how outside of like the intricacies of the allocation of what the goal of target 5 does. Like target 5 is never going to hit 7% in January, right? That's not the way it's managed.
Right.
What it's done is to kind of eat returns throughout the year, so that tactically can go to cash in November or December. It's really kind of targeting that interest rate with the least amount of volatility as possible, right? So it is a slow climb, outside of this year where it's hard to find shelter. The fund performed incredibly well. In 20 and 21.
There's no one who's not struggling, right? If not a fund company, there's not anyone who does portfolios and does any of this stuff. No one's hitting it. So, okay, good. So Norma, are you gonna play the yodeling music now when you come out for meetings? We can probably set that up for you. I think it's pretty cool.
I don't want to get booed out of the place. That's something I'm not good at. Exactly. One thing I wanted to throw in there, Matt, that yes. Dave brought up is the ease of use on this as well. So on current security platform, and as we transition over to the standard platform, it's an option. It's an investment separate account. It's an option. So in the event that you wanted to divest yourself from our solution, it's very, very easy to make the dive into anything else. There's no paperwork, there's no puts or on the back end, there's nothing. It's just, I want out, and you can do it. It's very, very easy to work with as well on the platform.
Okay, cool. Yeah, because it's one. There it is. It's a target 5 fun. Got it. We do have a question, which is cool because we're at about 5 or 6, 4 minutes left. What are you seeing as average comp for advisors on these types of plans?
Yeah, I'd say it's kind of similar to what you would charge like a brokerage. So, startups like 50, 75, somewhere around there, asset-based fees. Some advisors, if you have the capability, will charge outside the plan, because they don't want to chip away at the returns, right? So if you have the ability to kind of do fee for service, that might be a way to do it. But yeah, typically 50 to 75 if you're doing asset-based commission.
Right. And the way, Norman, if I remember correctly, you look for 7, right? So 7 there would be some basis points in there for the advisor as well.
That's
right. So you wouldn't have to mess with that 5. Right.
Do that on purpose. That's right.
Right. Cool. Good question. Any other questions from our audience? All right, 1:42. I'm gonna be on point and on time. Dave, any other comments from you?
No, just that we thought we were going to be short 45 minutes. So it's always
we're pretty good.
Yeah, the presentation's always longer than what you prep. No, I'd say engage your trusted third-party administrator partners like Definiti. Matt said he grew up in the TPA business. So did I. When I started my career, it was a record keeper that only did third-party TPA business. So I'm 100% bought into the value proposition that they bring, not only pre-sale, but also, your close ratios will go up if you've got an expert from Definiti in there helping you pitch design, not only from a DC perspective, but from a cash balance perspective, and plus the unbiased consultation, right? They don't have any skin in the game in terms of like who's going to be the record keeper, what the investment solution is going to be. Sometimes, plan sponsors like that when, because they're walking in just like they would trust their accountant. So don't try to do this business alone. You've got partners, and when you go in there it's a team sell. Cash balance is a team sport. It's not tennis, it's football, right?
Exactly. Norm, any last comments from you?
I just wanted to thank everybody. I know some of the stuff that I bring up without a chart may be more challenging to have described, and certainly I would make myself available to anybody that just go through your Definiti representative and have access to me too. I can certainly dive deeper into this if anyone has any questions.
You did a great job without the slides. We did it. We did no slide references at all in our 45 minutes. But thank you both for being interviewed today. I guess you could call it that. Matt King interview. At this point, I think it's to echo what both Norm and Dave said. If you've got questions on this, certainly right now you can talk to your local Securian rep. Hopefully this is, I guess we said, this access to Target 5 comes with us when we join the Standard family officially on 1/1. We are definitely looking forward to that. I know that, Dave's peers throughout the country are well versed in this. Norm loves to travel, get out there and talk about it. Please use us and your Definiti partners when you've got these cash balance opportunities. And with that, I think I'm turning this back over to my good friend Thomas Brennan. Tommy, thank you again for having us, and enjoy the rest of your afternoon with our friends from the Standard.
No, thank you so much, Dave, Norm, Matt. That was tremendous, and I don't think it can be lost on the existing market experience. I don't think it can be lost how important utilizing a solution like this is right now, especially when you consider, typically, all advisors know the story of how stocks and bonds typically have, inverse relationships. Well, Norm, we all know that that hasn't been the case.
Mhm.
We're riding a unicorn right now where everything has just been going down. So fixed income isn't the safe haven that it typically is. And for a firm that does not have the resources to manage this on their own, that's why the Target 5 solution, whether in totality or in part, can be such a huge win for advisors. To your point, Norm, if an advisor is doing it on their own, there's only one person to blame. When you have an experience like that. So, the flexibility of utilizing take the Target 5 either in totality or in part, there's great value there. Dave, I love the comments that you made with regards to the cross-sell opportunity. In my mind, I don't think it even needs to go very much deeper, other than if you're having a defined contribution, having a 401k conversation with a client or prospective client, and you're talking to them about advanced plan design and new comparability. As soon as new comparability or anything other than a pro rata allocation comes up, that's a cash balance opportunity as well.
Right.
And as any advisor in the business, it's I wish that we had 10,000 advisors throughout the week of the Definiti Retirement Academy, because in my mind, every advisor should be a retirement advisor, if for no other reason than to protect their existing book of business owner clients. And this just gives another opportunity to retain, to have better hands around your clients and give yourself better retention rate, because if you're not talking to your clients about this, I guarantee that someone else is. So Matt, Norm, Dave, thank you so much. Great seeing you all today. Really appreciate your contributions here, your partnership and your friendship, and great having you all here. Thank you so much.
You bet. Thank you all.
Thanks, Thomas.